Hey friends, welcome back to the channel. My name is Sanji. Today we're going to look at ETFs that you can use to track the S&P 500 in the US. Now the idea is you pick ETFs from the Australian Stock Exchange and their underlying holdings are actually the S&P 500 index over there in the US. It's a nice way of not having to invest in the US through the stock exchange. You can just do it locally here. Now this video is in response to a question I had from one of my viewers where he said, hey, can you have a look at the S&P 500 and specifically how do you do it through ComSec? So in this video, I'm going to go through what the S&P 500 index is, just in case you didn't know, you've heard the term, but you didn't know what it's actually referring to. We'll look at the 4 ETFs that I think you can use to track the actual index. And then we'll also have a bit of commentary where I'll say, what I would do if I was in this situation and I wanted to track the S&P 500, how I'd find the balance between them. Would I use two of them? Would I just use one of them? How would I go about it? And what do I actually do? Because I actually don't use any of them. To be completely honest and transparent, I don't actually track the 500 directly. By the way, if this is your first time watching one of my videos, welcome, so good to have you. I generally do videos on personal finance and investing with an Australian context, so you can check out all my various other videos. Please do consider subscribing both to the YouTube channel and also following on Instagram. I'm doing a bit of action on the Instagram, so I think you might enjoy that there. If you do want to skip ahead, feel free to use the timestamps along the bottom in the description or in the timeline. So it's all cut up so you can go to exactly what you want to do in there. So the first question you're probably asking is, what is the S&P 500? It literally stands for the Standard & Poor's 500 Index. That's been around since the late 60s. Now, Standard & Poor's is actually a private company. This is not some legislated government organization that said it. This is actually a private company that has said, in the universe of companies you can invest in the US, let's come up with a way of using an index as like a proxy to know how the share market is performing. And they set up this index where they said, let's look at the top 500 companies. Let's weight that index. So how much does each company account for it by the market value of that company? So it's called market cap weighted. So that's why you'll find the top companies will account for more of it. So when you look at the companies on the S&P 500, it's nothing exciting. Let's be honest. It's all the usual suspects. Apple's there, Microsoft, Amazon, Facebook, every version of Google out there in the form of Alphabet, Berkshire, JP Morgan, a bank, who would have known? Tesla has come in, J&J is also in there. Now, this isn't unique to the US. We have the same thing here in Australia. So S&P also makes an index for Australia. You would have heard of this, the S&P ASX 300, S&P ASX 200, and they've got like mid caps, small caps, all of that. So the same company, Standard & Poor's, has a methodology where they do the same thing for Australia. And we've got ETFs that track that. So the link between the index and the ETF happens the following way. Basically, you've got the index companies or the ratings companies that go out and they build these lists. They say these are the top 500 companies, or this is the all world index. So that's what your MSCIs, your S&Ps, your selectives, they sit down and they create these lists. Then you've got ETF companies like your Vanguards, your BetaShares, BlackRocks, State Streets. They'll come along and they'll build ETF products that follow the list of things in the index. So let's now transition to talking about the actual ETFs that I want to compare. Immediately you can see there is a variation in market cap fees, but the benchmark is the same for three of them except the last one, and then the top holdings all exactly the same, because if you're tracking the same index, of course you're going to have the same holdings. So where's the differentiation? So let's have a look. IHVV is the biggest one. It's a big player, BlackRock. Naturally, what you generally see is whenever an ETF is beating everyone on fees, it's usually got a large market cap. Because if you're tracking the same index, why would you bother trying to compete on anything other than fees? So naturally, the iShares BlackRock product, 4.3 billion, that's a pretty big ETF. Has 0.04% fee, 40 cents on every $1,000 you're investing. That's pretty good, tracking the S&P 500. Very liquid product. But the challenge is the denomination, or the actual dollar value of it, is like $500, which I think can be a bit challenging for some people if they want to invest in it, especially if you're trying to optimize for brokerage. IHVV is actually the same product, but with currency hedging involved. I'll come back to that, especially when we look at the performance. But generally, when you have currency hedging, they're trying to manage against the actual performance of the currency, the Australian dollar against the US dollar. That's why they throw in a little bit of a higher fee. You get a 0.1% fee, same index, same holdings, nothing too much dramatic there. SPDR, SPY, S&P 500 tracker, much smaller market cap, and look at their fees, 0.09%. When you're looking at that against the IVV of 0.04, it's a challenge as to why you would bother investing in the SPDR product and why not just go straight for IVV. I've thrown it in there so that you've got an idea. You can already see which way I'm leaning on this. Now, QUS is interesting. BetaShares product. Didn't always used to be QUS, or didn't always used to be an S&P equal weighted product. It used to be something else altogether, and then they changed the actual index that they're tracking. Much higher fee, equal weighting. Let's talk a bit about that. Equal weighting basically means instead of having market cap weighting where the different size of the company determines how much it allocates in the ETF. So for example, with the market cap ones, you've got Apple being allocated 5.6%, Microsoft 5.35%, and then you can already see by the time you get down to Johnson & Johnson, it's only 1. And then the last company is probably 0.001% or something very, very small. Whereas with an equal weighting ETF, it's literally all equal. So Apple accounts for the same amount as the smallest company, as the Microsoft, as Amazon. It's all equally weighted. Now, I haven't done a lot of research, I'll be honest. I haven't done a lot of research on this. But I think the first question I would be asking is, first of all, is it outperforming? And secondly, is the outperformance or the benefits of equal weighting worth the 7 times more in fees you're paying? 0.04% versus the 0.3% fee. So now let's have a look at performance over the last 12 months. Not the best thing to always do, naturally, because looking at historical performance to try and predict the future is like trying to drive your car while looking in the rearview mirror listening to a podcast. And you see the road behind you is straight, so you assume the road in front of you is straight. It's not always going to work. But hey, you got to give people something to reference on. So here we have a situation where you've got 4 ETFs and only 3 lines on the graph. That's because IVV and SPDR are actually sitting right on top of each other, which makes total sense because they're tracking the exact same index. Why wouldn't that be happening? And then you've got IHVV sitting a bit above and QUS, the equal weighting product, sitting a little bit below. So 10% against 18% against 28%. So let's now zoom in on what's going on with IVV and IHVV. They're the same ETF, right? But one's just currency hedged and the other one's not hedged. How does that result in a 10% outperformance? Let's have a look. First thing you got to look at is what the Australian dollar do against the US dollar in that time period. You can see about a year ago, 1 Australian dollar was getting us 70 cents US. Now it's getting us 77 or 78 cents US, really. So the Australian dollar has gotten stronger against the US. Now this happens all the time, the currency goes up and down, but it can impact your ETF investment because when the Australian dollar goes up, international ETFs generally, which are not currency hedged, start to go down in value relative to the Australian hedged ones. Now, I did do a video on this where I went into a little bit more detail. Surprisingly, not a lot of people watch that video. You should check it out. I actually there's a whole diagram with 4 quadrants where I explain it out. But the key thing to know is when you're investing in an unhedged ETF, what you're doing is you're investing in both the underlying performance of the companies that you're investing in, plus the performance of the currency. Whereas when you invest in a hedged ETF, you're investing in the performance of just the company and the currency is sort of being managed through the hedging. So this is why you're in this situation where IHVV has outperformed because the Australian dollar went up. Now, if we were in the opposite situation, where in the last year the Australian dollar went down against the US, you'd see the opposite. You'd see IVV outperforming IHVV. So bringing this all in together, what would I do if I wanted to invest in the S&P 500? I'd probably use something like IVV, purely because it's low fees, good liquidity, very large market cap. There's a lot of confidence in the market towards it. I don't know if you need the equal weighting product of QUS. And even if it is, the thing you have to consider is it worth paying 7 times more in fees? The other thing I would be wondering is, would you even consider SPDR? I don't know why you'd consider SPDR. I don't know why State Street still puts the SPDR product out there. Maybe there are people in there who invested a long time ago and they can't get out because they're going to be hit by a big capital gains hit. So maybe that's why. But, paying 2 times more in fees for something that tracks the exact same product, and you saw the performance is pretty much the same. Why would you pay more in fees? So that then leads to, would you get IVV and IHVV? Which would you get? So naturally, if you just want to optimize for fees, you go with IVV and you run with the currency risk. But if you want to be a little bit conservative, obviously you go somewhere on that spectrum of, do you get 100% IVV, 100% IHVV, or do you go somewhere in the 50-50 range? I would go probably 50-50 range just because I don't know which way currency is going to go. I know there's a lot of research out there that says, over a long period of time, it doesn't really matter. Again, personal preference, do your own research on that. So what do I actually do for investing in the US? I actually don't use any of these products. I actually use broader ETFs like VGS and VGAD. Now, this is a personal preference. I don't like to get too specific with my products. I like to have global products that I know carry, heavy weightings towards certain countries. So I know VGS and VGAD have something like 60, almost 70% investment towards the US. I already get that US exposure. There's probably a lot of overlap with IVV as a product. If I really saw an opportunity where I thought maybe the US is heavily underpriced, I might jump in and pick up IVV. I don't really see that right now. I don't really see that happening anytime in the future. So I run very happily with a product like VGS. That's what I do. Hey, that's it for this video. Make sure you check out some of my other videos on ETFs. Also, I do have a mailing list that I'm trying to build up a bit. Check out the link below to subscribe to that. I also have an Instagram page that you've seen, I'm sure. And as always, check out some of my other videos on personal finance and investing with an Australian context. That's it for today. Bye for now.